So I want to take a minute to talk about old people and more specifically, people who have equity in their homes because people who have equity in their homes are old. You may not consider yourself old, but if you've been making your mortgage payment for long enough to have a significant amount of equity in your house, you're probably an old person. But the reason that I'm talking about old people and equity is because I want to talk to you about how you should be using that equity. And you should be using that equity. In this environment right now, in the middle of COVID, um, there's no reason not to use your equity. You fall into one of two categories. The first category, which is people who have debt that's not mortgage debt and have equity in their home. That category is, I have someone that I'm helping right now that's in that category. And at first, the guy was a little bit reluctant to pull the equity from his home because he, wanted to pay his house off faster. And he said, man, I know I got this other credit card debt. I'm going to tackle that and try to pay that off first. But I don't think I want to put any more debt in my house, which that just doesn't make any sense. If you're trying to pay off your debt, the best thing to do is structure in a way so you're making as little money as possible towards the interest and you're paying it off as fast as possible. So sticking with the high interest credit card debt, just because you don't want to restructure it onto your house is not the best plan. And this guy saw the light and decided to go with a more strategic plan. And at the end of this month, he's going to be saving $2,000 a month. And, he's going to go from paying $5,053 a month to $2,920 a month. He's not going to increase his debt at all. He doesn't have to pay any cash out of pocket to do that. And it's just a no-brainer. And then he's going to have a plan for paying off the rest of the debt a lot faster because he has a lot more disposable cash. So I'm going to show my screen, share my screen with you so you can see how he did that. As you can see, first on the first part of his profile is just the mortgage debt. He pays he has about $130,000 in a mortgage and $29,000 on a second mortgage, which accounts at $1,721 a month. We're going to skip past the student loans because they suck, and the credit cards are at $56,634. And he's paying $1,837 a month on that $56,000 in credit card debt. So take a minute for a second. He's paying $1,800 a month on $56,000 worth of debt. That's super high interest, where if he makes the minimum payment, it'll probably never get paid off. And then he has a mortgage where he's paying $1,700 a month, which is a testament to how much better mortgage debt is than any other type of debt, because especially credit card debt, because he has triple the loan amount of the mortgage debt, but the monthly payment on it's only $1,700. And at a third of that loan balance, the monthly payment is more at $1,800 a month. So we want to get rid of that. So we're going to take this $1,837 or the $56,634 of debt, and we're going to wrap that into a second mortgage, a new second mortgage with a lower interest rate than the first one. So even though the balance is higher, the monthly payment's only $397 a month. And then the first mortgage, we're going to refinance that too, because rates are at historic lows, like I've been preaching about for the last couple of months. The government has to keep them low. And it's true, they're at historic lows. They're lower than they've ever been. If you haven't refinanced your home, you should. Skipping past the student loans again, what are you going to do? And look at the credit cards. Gone. No more credit card debt. $1,800 a month before, $0 now. So his total monthly obligation with the mortgages and student loans is $2,920 a month, where before he was paying $5,053 a month. Boom, $2,133 a month in monthly savings. Was that a good decision? Absolutely it was. There's no reason for you to be paying $5,000 a month in high interest debt that's not lowering the balance when you could be paying $2,900 a month in debt that is low interest, and it gives you a lot more disposable income to pay that down. Now, his plan, he could take that $2,000 a month, put it in his pocket, and just live a better life. But we're not going to do that. He's going to take the extra $2,113 a month, and he's going to apply that towards the second mortgage first to eat at it to get it paid off. So if he takes that $2,133 a month and every month pays towards that $81,439, which is over and above the $397 minimum monthly payment. He's just keeping his payment the same, that $5,053, so his lifestyle doesn't change at all. He's going to have that $81,439 paid off in 38.179781 months or 3.18 years. Come on. That's a no-brainer. That is absolutely what he should do. And if he takes the $2,133 a month and starts applying it towards the $133,500 after he's paid off the first mortgage, he's going to have that one paid off in 5 years. Or let me check, make sure that's right. Yeah, a little over 5 years. So you're talking about less than 9 years paying off your first mortgage, your second mortgage, the credit card debt. There's no way he would have that paid off the way he's currently structured right now, making the $5,053 a month payment. He'd be in those payments for 30 plus years because the credit card debt doesn't go anywhere when you're only making the minimum monthly payments. All right, let's talk about the second group of people. I know we're 6 minutes in. If you can stick with me, please do. The second group of people is people who don't have other debt. These are the people that the rest of us wish we were, right? You have equity in your home. You have money in the stock market. And COVID hit and you just lost 15, 20, 25%. Feeling real bad right now. Well, this could be a very good thing for you because I'm sure your advisors and everybody that's around you is telling you, hey, keep your money in there. It's going to go back up, which, you know, we all know this is going to be over soon. And the stock market is eventually going to go to where it was at before and beyond eventually. But you could take that cash that you were not really using before because it was just sitting in your home bearing no interest. You weren't using it at all. It's money that is available to you at the very, very subsidized, cheap prices of 3%. You could pull that out and put that into the stock market while it's low, and we know it's going to go back up to where it was before. I guess you should say we know it. I mean, I guess the economy could crash and everybody, you know, dies of COVID, which, whatever. I don't think that's going to happen, and I don't think you think that that's going to happen. So you take that cash and you put it into the stock market while it's low. By the time it's back up to where it's at, you're actually in a much better position than when it starts. So this could actually be a good thing if you're sitting in that position. Anyway, you could disagree with me. I know some people do. A lot of people consider it risky. I don't. Call me. Well, actually, I don't put my number up there, even though I say I normally will. I just don't like putting my number on Facebook. But private message me. I would love to talk to you. And if you have a better plan and you want to school me, please do. I'm open to it. I don't see any other way to do this. It just doesn't make any sense to me for people who own their home and have equity and they're not using it. So. All right. I know this was a long one. I appreciate you guys sticking with me that are listening to this right now because I made you stuck it out for 8 minutes. I'll catch you later.